faithfully delivering value, interpreting great books from around the world. Hello, this is Sally's Book Talk. Today we'll be exploring the book Templeton on Contrarian Investing. Templeton was named by the New York Times as one of the top 10 global fund managers of the 20th century, with an investment career spanning 70 years. In the latter half of the 20th century, the U.S. investment scene was always under intense spotlight. Born in 1912, Templeton was an academic standout in his youth. A top economics student at Yale, he received the Rhodes Scholarship after graduation and earned his master's in law at Oxford. Templeton formally entered the industry at age 26. In 1938, he founded a securities advisory firm in New York, growing it into a top 10 national firm within a decade. In 1954, Templeton launched his first fund in Canada. Over the next 38 years, it grew nearly 200-fold, reaching $21.3 billion in assets. And this was just one member of Templeton's vast fund family. Templeton pioneered global investing with extraordinary foresight. In the 1950s, he spotted opportunities in Japan, and by the 60s, was making large-scale investments there. Later, he became among the first American investors to discover South Korean and Chinese markets. Forbes magazine once hailed him as the pioneer of global investing. Templeton was an unconventional investor who thrived on going against the grain. For instance, when W2 erupted in 1939 and others fled stocks, he borrowed money to dive into the market. Or during the 70s market slump, when Business Week's August 1979 cover declared the death of equities. Right then, Templeton entered the market, predicting a massive bull run. Then, in 2000, as the Nasdaq soared and barons mocked Buffett for not getting internet stocks, Templeton raised capital to short the market. Remarkably, every time Templeton bet against the crowd, he struck gold. His 1939 stock purchases quadrupled in value. His 1979 move perfectly timed the U.S. bull market start, and his 2000 Nasdaq short made fortunes. So how did he do it? This book holds the answers. Written by Templeton's grandniece and her husband, close relatives who worked alongside him for years, this book details his greatest investments and the secrets behind his success. I'll break down the essence of this book for you in 3 parts. So, Part 1, how Templeton practiced contrarian investing. Part 2, how Templeton approached global investing. Part 3, how Templeton dealt with stock market bubbles. First, let's dive into Part 1, how Templeton did contrarian investing. Contrarian investing means going against the grain, buying when others aren't, and selling when everyone is. Templeton did this to buy the cheapest stocks, a strategy he learned from his father at a young age. Templeton's father, Harvey, was a lawyer and speculator. His office was on the town square opposite the courthouse. Back then, farm incomes were low, so some farmers mortgaged their farms to borrow money for other businesses. If they failed, the farms were auctioned off to repay debts. Typically, auction starting prices had a discount compared to market value, which attracted many buyers. If several buyers wanted the same farm, they bid against each other, and the highest bidder got it. At every auction, old Harvey would watch from the second floor and never participated in the bidding. So most of the time, he was just an observer. But if a farm had no bidders, old Harvey would dash downstairs and buy it for very little money. Later in his investment career, Templeton adopted this tactic from old Harvey and called himself a bargain hunter. He searched globally for the cheapest stocks, buying Japanese stocks in the 60s, US stocks in the 80s, or Korean stocks in 2000, all for one reason: they were bargains. In 2004, Templeton bought 2 Chinese stocks, China Mobile and China Life, and later made 10 times his investment. His reason for buying was their cheapness. And the stock market mechanism is similar to farm auctions. When many people are scrambling to buy, you have to pay high prices. But to buy cheaply, you must act when no one else is bidding. When other investors aren't fools, why would they leave a cheap stock for you? In other words, when can we snag a cheap stock right under everyone's nose? Templeton tells us there are three situations where you can buy them. First situation, the stock has issues, poor industry outlook, slow company growth, mismanagement, heavy debt, lawsuits, or negative news. If the problem is confirmed true, it makes sense people avoid buying. But some issues are often just temporary troubles. Investors avoid them due to emotional overreactions. At such times, if you're confident in the company's long-term prospects, it's a perfect chance to grab bargains. For example, say a company's new factory faces production delays. After the announcement, the stock drops 30% in weeks. While delays may affect next quarter's sales growth, the company has strong momentum and ample funds. It's temporary and fixable. A 30% drop is overreaction. Templeton compared it to panicking and rushing to ICU for a small paper cut that just needs a Band-Aid. At such moments, rational investors should quickly assess the problem's severity and capitalize on others' recklessness to find bargain opportunities. The second situation is when a stock's value goes unnoticed by the market. Like Hitachi stock in the 1960s, seemingly ordinary, but Templeton found its independent subsidiaries' earnings weren't included in reports. Counting those subsidiaries' earnings, Hitachi's profits quadrupled, making it a clear bargain stock. Templeton believed this value would surface eventually. After he boldly invested, Japan revised accounting rules. Hitachi consolidated subsidiaries' earnings into financial statements. Only then did the market recognize its hidden value. The stock price surged dramatically. The third bargain hunting situation is when sudden events plunge markets into extreme pessimism. Events could be political, like government changes or failed negotiations, or economic ones, such as oil embargoes, financial crises, or even wars or terrorist attacks, like the Gulf War or 9/11 attacks. Sudden events cause sharp market declines, but these downturns bottom quickly. After Pearl Harbor, markets bottomed in 12 days. Korean War in 13 days, Gulf War in 50 days, 9/11 in 5 days, JFK assassination in 1 day. Meaning, even extremely severe events have short-lived negative impacts. So when sudden events strike and markets hit peak pessimism, buying against the trend often gets you rock-bottom prices. Templeton famously said, "The time of maximum pessimism is the best time to buy." Templeton's first major trade was buying U.S. stocks the day 282 broke out. It was 1939. The U.S. economy had stagnated for a decade after the Great Depression, and fears of European war hung over markets. Amid this fearful atmosphere, the U.S. stock market plunged 49% in 1 year, a full-blown stock market disaster. On September 1st that year, Germany launched a blitzkrieg against Poland. The long-dreaded war arrived. Market sentiment became unanimously bearish on the global economy. The stock market resembled an auction with no bidders, and Templeton, who'd been watching, charged in. He practically bought with his eyes closed, buying $100 worth of every stock under $1, ignoring industries and financial reports. Most of these were stocks he'd never individually researched. 4 years later, before war ended, Templeton's gamble paid off, tripling his investment. Only 4 of his 104 stocks lost value or went bankrupt. Capitalizing on extreme pessimism requires one key insight. The stock's prospects must be reversible. In 1939, everyone predicted war's economic destruction. But panicked sellers overlooked something. War would bring massive orders to U.S. companies. Meaning while global economies would suffer, U.S. companies stood to profit enormously from war. Templeton saw this reversal. Now, Why specifically buy sub $1 stocks? These low-priced stocks were typically loss-making companies. Templeton had studied Civil War and WWI history. Profitable companies faced heavy excess profit taxes during wars, but companies turning losses into profits paid nothing. He deduced the U.S. government would repeat this policy, so loss makers would see higher actual growth during war with bigger reversal potential. That covers the 3 bargain hunting scenarios. Next question. How do we actually measure if a stock is cheap? Templeton used a comparative method. Identify stocks in the same sector, calculate their financial metrics, and compare values to determine which was cheaper and by how much. He primarily used 3 metrics. First, the price-to-earnings ratio. Price-to-earnings ratio, which measures stock price divided by earnings per share. Simply put, it's the investment payback period. For example, a PE of 20 means it takes 20 years to recoup your investment. Generally, lower price to earnings means cheaper stocks, but it's not absolute. Price to earnings flaw is it uses historical earnings data and ignores future growth. For instance, take 2 stocks. Stock A has flat earnings this year, stock B doubles. Even with identical current PE ratios, stock B is actually cheaper. To fix this, we use forward P dash current stock price divided by future earnings per share. Templeton used projected earnings 5 years out. Here's his calculation method. First, predict future average growth based on historical earnings growth. Then calculate EPS in 5 years using that rate. Finally, divide current price by that future EPS for forward PE. Templeton considered forward PE below 5 as cheap. The second metric is PEG ratio, PE divided by earnings growth rate. Lower PE means higher undervaluation potential. For example, in the 1960s, Templeton analyzed Ito-Yokado, a Japanese department store chain, with a price per ounce of 10. Meanwhile, US-based Sears had a PE of just 8. Despite Ito-Yokado's higher price per ounce, Templeton saw it as cheaper. Why? Ito-Yokado had 40% growth rate versus Sears' 15% PEG ratio reveals the truth. Ito-Yokado's PEG, 10 divided by 40 equals 0.25. Sears' PEG, 8 divided by 15 is approximately 0.53. Clearly, Ito-Yokado's PEG was much lower. PEG's logic aligns with forward PE, but the calculation is simpler, so it's easier to apply. In 2004, Templeton invested in China Mobile using the PEG ratio. At that time, China Mobile's PEG was 0.55, while the global telecom stock average was 0.84. China Mobile had the lowest PE ratio. The third metric for measuring stock price is the price-to-book ratio. Its formula is stock price divided by net assets per share, where net assets represent the company's replacement cost. So the price-to-book ratio essentially gauges stock price from a replacement cost perspective. For example, a PB ratio of 5 means that with the current stock price, you could rebuild 5 identical companies. Clearly, a high PB ratio indicates high asset premium and expensive stock price. Conversely, a low PB means the company is relatively cheap. In the late 1970s, the U.S. stock market's PB ratio fell to 1, a low only seen during the Great Depression in 1932. Templeton, thus, he concluded the entire market was at its cheapest point in history. So he bought at the bottom. In hindsight, that time marked the start of a long-term bull market in the U.S. When comparing PB ratios, we must also account for inflation's impact on asset data. For instance, a company built 5 years ago has a PB of 10, but the net assets used are from 5 years ago. If inflation was 10% over 5 years, considering that its assets today should have appreciated by 60%. Thus, the actual PB ratio drops to around 6 point something. After adjusting for inflation in the 1930s and 1970s, the actual PB in the late 1970s was even lower than in 1932. Therefore, it further convinced him stocks were cheap. Okay, that covers the three metrics for measuring stock prices. Beyond that, there are two phenomena that can help confirm if stocks are cheap enough. The first is mergers and acquisitions, where companies buy other companies' stocks in the market. The second is buybacks, where companies repurchase their own stocks from the market. Generally, M&A is initiated by peers or competitors, while buybacks are by insiders who know far more about the company than external investors. If they're willing to spend real money buying stocks, it's often a signal that prices are cheap. Templeton advises using multiple metrics and methods to measure stock prices. At first, he believed any method becomes ineffective once too many people use it. For example, Buffett's mentor, Benjamin Graham, introduced a method. If a stock's market value was lower than its inventory value, it was a bargain worth buying. That was clearly a bargain stock. But as more investors learned this approach, finding such stocks became nearly impossible. Because if they were that obviously cheap, they'd have been snapped up already. Second, using multiple methods provides insurance against each method's limitations, ensuring we find truly cheap stocks. Okay, that covers contrarian investing. Its core is buying cheap stocks. We can identify opportunities through three scenarios while using metrics like PE ratio, PE ratio, PB ratio, plus market signals like M&A and buybacks to confirm value. Next, part 2, how Templeton practiced global investing. The essence of Templeton's global investing was still bargain hunting. He looked globally to expand his search and find more cheap stocks. For instance, in the 1960s, he invested in Japanese stocks precisely because they were cheap. Japanese stocks had PE ratios 80% lower than U.S. markets, but most American fund managers were biased, viewing Japan as a defeated nation producing cheap daily goods and low-end textiles. So they dismissed both Japan's economy and its stocks. Yet, starting mid-1950s, Japan shifted to high-value exports. Cameras, sewing machines, semiconductors, radios, and machinery growing 2.5 times faster than the U.S. Templeton recognized this shift, believing cheap Japanese stocks would yield huge returns. Indeed, from 1959 to 1989, Japan's Topix index grew 36-fold, yet most investors only noticed Japan's rise in the 1980s. Similarly, during the 1997 Asian financial crisis, when foreign investors fled Asian markets, Templeton doubled down on Korean stocks, again because they were cheap. After the financial crisis, Korean stock prices were nearly halved, with average price-to-earnings ratios dropping from 20 times to below 10. Additionally, Korea's debt situation differed from Thailand's. Its issue was mostly short-term maturities, creating a liquidity crunch rather than structural problems. When the IMF provided aid to Korea, Templeton believed recovery would be swift. He invested Contrarian again. Within 2 years, his investment grew 267%. In the U.S. fund industry, Templeton pioneered global investing early and reaped massive rewards. His success stemmed from overcoming information gaps in overseas markets. Beyond policy restrictions, U.S. fund managers avoided foreign investments mainly due to unfamiliarity with local laws and regulations. Lacking comprehensive data made foreign investments risky, easy to stumble into pitfalls. For example, a foreign company's stock might appear cheap, tempting you to buy, but you might miss that local price controls cap its profit growth. Explaining why it's cheap, Templeton's solution: personally hunt down every scrap of data and information. He championed the extra work hour principle. He believed successful investors differ by willingly spending extra hours, researching, reading reports, investigating companies. Any effort could be transformative. In the 1980s, suspecting Mexico's phone company's financials, he manually counted Mexico's telephones and estimated total fees to verify data, an enormous research effort. But after this work, he confirmed the stock was deeply undervalued. If such effort seems daunting, Templeton recommended an easier path: buying foreign stocks through specialized funds. He practiced this himself, investing in Korea via a Korea-focused fund rather than direct stock purchases. So how do you find such funds? Templeton believed the key is selecting the right fund manager. Specifically, first see if their core philosophy aligns with yours. For example, if your philosophy is buying bargain stocks, make sure theirs is too. Second, check if they practice what they preach. Say a fund manager claims to only buy low PE ratio stocks. Then look at their holdings data. Calculate the average price to earnings ratio of their stocks. Also, refer to research firms like Morningstar. Their fund analysis reports reveal the fund's style and characteristics. In short, you need a fund manager whose approach matches yours. Finally, global investing involves a special issue: currency risk when investing in foreign stocks. You first convert your currency, then use foreign currency to buy stocks. After making profits, you must convert foreign currency back to your own currency. If the foreign currency depreciates during your investment, your returns diminish accordingly. To avoid this risk, Templeton set two conditions for countries he invested in. First, low debt ratio and high savings rate. Second, heavy investment in industry to boost exports and maintain a trade surplus. Countries meeting these conditions usually have strong currencies and low currency risk. All right, that covers Templeton's global investing. His method remains hunting for bargains. When buying foreign stocks, expect more extensive information gathering and research. Alternatively, delegate to specialized funds while prioritizing countries with strong currencies. Next, Part 3, How to Deal with Stock Market Bubbles. Templeton famously said, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." This describes a full bull market cycle. When everyone's pessimistic, a bull market starts brewing. That's when contrarians should buy. But as the market moves from pessimism and skepticism to optimism and euphoria, everyone scrambles to buy, signaling the bull market's end. Contrarians should sell and exit then. But exiting only prevents losses. How can we actually profit? Indeed, there are. The book details Templeton's two methods. First, short selling, which means selling first and buying later. When stock prices peak, sell first, then buy back after they fall to profit from the difference. Short selling doesn't require owning the stock. You can borrow shares to sell, known as securities lending. Templeton's most legendary short was executed in early 2000. During the 90s, NASDAQ tech stocks experienced an unprecedented bull market. Tenfold or hundredfold gains were common. By December 1999, NASDAQ's average price to earnings ratio hit a record 151 times earnings. Media overflowed with praise for the new internet economy as frenzied buying peaked. Then, Templeton judged NASDAQ's bull run was ending and a crash imminent. He decided to short stocks that had tripled within 6 months of IPO. Why this choice? Because many dot-coms had no profits. Founders' only exit was cashing out post-IPO. NASDAQ had a 6-month lockup period rule. During this time, founders were barred from selling shares. Templeton reasoned that after lockup expiration, founders would immediately cash out soaring stocks. He timed his short for early 2000. Because Q1 2000 had nearly $100 billion in restricted shares becoming tradable, Templeton predicted this massive sell-off would trigger NASDAQ's collapse. His strategy: target stocks trading 3 times plus above IPO price, shorting them 11 days before lockup expiry. He shorted 84 such stocks, totaling $185 million. NASDAQ plunged in March 2000's second week. Many shorts fell 90% within a year, yielding massive profits. Of course, shorting carries significant risks. First, Stock prices can only fall to zero, capping gains, but can rise infinitely, unlimited loss potential. Second, timing shorts is difficult. Market bubbles burst gradually. Even if a crash is imminent, prices might surge further first. So, short selling requires advanced trading skills, which ordinary investors might find hard to pull off. Relatively speaking, Templeton recommends a safer alternative: buying bonds. A bond is a loan certificate. When it matures, you get back the principal plus interest. For example, a $100 bond with a 7% interest rate earns $7 per year. Generally, bond interest rates are higher than bank deposit rates. When the stock market is at its peak, withdraw your funds from stocks. Investing in bonds avoids stock price drop risks and provides relatively safe interest income. It's a defensive play. On the flip side, bonds can be traded on the market, and their prices move opposite to interest rate trends. Conversely, when interest rates rise, bond prices fall. When rates drop, bond prices climb. When a stock market bubble bursts, it might trigger an economic recession. At such times, central banks cut interest rates to ease the recession. As interest rates fall, bond prices rise, letting investors profit. In short, buying bonds is simple and more reliable. That wraps up the core content of this book. To recap briefly, Part 1 covered the basics of contrarian investing. Its essence is buying cheap stocks. We can gauge if a stock is cheap using metrics like price to earnings ratio, PEG ratio, price to book ratio, plus market signals like mergers and buybacks. Part 2 introduced Templeton's global investing approach. Key points are gathering as much info as possible, doing your own research, or using specialized funds, but always watch for currency risk. Part 3 detailed two methods: short selling and bond investing, to profit even when bubbles burst. Contrarian investors are like hunters, relentlessly scouring the capital jungle for bargains. To succeed, you must go against the herd. Buy when others sell in despair. Sell when others buy frantically. Templeton said, "This demands huge perseverance but delivers the richest rewards." Hey, that concludes our interpretation of Templeton Teaches Contrarian Investing. The listening notes are below the audio. See you tomorrow.